Hey guys, if you have read my book titled Mean Reversion Trading Using Options, or you follow me on social media, or you're a member of a Discord group, you must know that I take only one kind of trades, options trades, for my regular trading, and these are either bull call spreads when I'm bullish in the markets, and bear put spreads when I'm bearish. But that doesn't mean that I haven't tried any other option trades, or because there are hundreds of ways of constructing trades using options, and it just basically depends on your risk tolerance, your experience level, how much money do you want to risk per trade. So that's why I have settled on a trade structure called a debit spread, because that makes my life really easy. The trade structure is not complicated at all, and I can risk as little as $50 per trade, and there is no upper limit. Having said that, in this video, I want to touch on a particular kind of options trade called an Iron Condor, and you must have heard of this trade because it's very common. Now, the only difference in the trade that I'm going to cover today is it's a pre-earnings Iron Condor. So usually what people do with Iron Condors is Iron Condors are actually really simple. So all you're doing is you're selling a call credit spread. So let's say a stock is at $100. Based on your analysis, you figured out that in the next 30 days the stock will not move above $110. One way of doing that is you would sell a call option, a 110 call option, and that will bring you some premium, and you if the stock doesn't go above 110, you keep that premium. Now the problem with selling naked call options like that is that if the stock goes up, so because anything can happen in the stock market, uh, let's say the company that you were selling a call on gets bought out, right? So there is a news that somebody else is buying that company, and the stock shoots up like 20%, 30% in a single day. Now, if you're selling a naked call, you're looking at massive losses, and there's no limit to the amount of losses you can incur on that trade. So the safer way of doing that is to sell a call credit spread, also called a bear call spread. So what you do is you're selling that 110 call because you don't think that the stock will go from 100 to 110 in the next 30 days, but you also want to play safe. So what you could do is you could buy a 115 call at the same time. So what that does is it provides you some protection. So if the stock starts going above 110, let's talk about the buyout scenario that I was giving you. So let's say that the company gets bought out, or maybe it was a biotech company and their drug gets approved, and the price shoots from $100 to $150 the next day. Now that's a massive move, but anything can happen. So what will happen is, as this price goes above $110, which is the call that you sold, you will start seeing losses in your account. But once it goes past the 115 strike that you bought, your losses will be capped. So you are selling 100 call, you're buying 115 call as a insurance or protection, and that way you're capping your risk. So that's called the call credit spread, and it's very common. Like I would say 90% of the people, option traders, they just do credit spreads because that's what has been popularized on the internet. So that's on the call side of the equation. Let's say you are bearish. So same example, a stock is trading at $100 per share. Based on your analysis, you determine that the stock is not likely to fall below 90 in the next 30 days. So now you could also do the same thing on the opposite side. So you would sell a 90 put option, and then you could buy a 85 put option at the same time for protection, and that is called a bull put spread. So you sold a bull put spread. Your outlook is bullish because you don't think the stock will fall below 90. You think the stock will either not fall that much, even if it falls, like it whipsaws around, or it will keep going up. Now, if that happens, if it doesn't fall below 90, you get to keep the credit that you got by selling that put spread. So that's the put spread, and then on the upside you have that call spread. What an iron condor really is you sell both of them at the same time. So you stock is at $100 per share, you sell a 110 strike call, you buy a 115 strike call for protection, and then at the same time you sell a 90 put and you buy an 85 put at the same time. So you're selling a call spread and you're selling a put spread. And the cool thing about this is that if you were to just sell a call spread, right? So you would bring in some credit. Now in this case, you're adding a put spread, so you are bringing double the credit. So the call spread will bring you some credit, the put spread will bring you some credit, and your margin requirement doesn't change because you can only lose either on the call side or the put spread. You can lose in both directions. So that's the beauty of iron condors. Now the one that I'm talking about is a pre-earnings iron condor, and these are really, really fast moving trades. So you take the trade one day before the earnings event, and then you close the position the next morning. So let's say this example I'm giving you tonight is Netflix. So Netflix is reporting earnings today on Tuesday after market close. So you could sell an iron condor today before the market close for some credit, and in next morning, if Netflix doesn't move around too much, you buy it back for a debit, and then that's how you make profit. Now the cool thing about these pre-earnings iron condors is if you read any literature on iron condors basically make money on IV implosion. So you sell the iron condor when the options, the implied volatility on the options is high, and you make money when that IV comes out of the options. And the cool thing about applying this strategy to earnings is just one day before earnings events, the IV of a stock or options, IV of the options on a stock is at its highest because there is a lot of uncertainty built into the earnings event. Nobody knows if the earnings will be bad or good, and even if you somehow know that, you never know how the market will react to it. So there is a lot of uncertainty that keeps building up as the earnings event approaches, and it's at its highest level an hour before market close. So the Netflix example I gave you today, Netflix reports earnings today on Tuesday after market close. So the IV on the options will be at its highest 1 hour before the market close. So you could sell the iron condor 1 hour before the market close, and tomorrow morning after the earnings have been announced, all that uncertainty that was built into the options, all the juice, the premium that was built in, will be drained out because all the uncertainty is gone. So the earnings have been reported, market reaction is in front of you. So the IV will, there's a phenomena called IV implosion. So next morning when you wake up, you will see that the value of that iron condor or the option that you have sold has dropped dramatically. And so let's say you sold the iron condor for $133. The example I'll give you, that is the example. You could buy the iron condor back for 10 cents the next morning. So within few hours, this is the 24-hour trade. Within a few hours, you can make a really good amount of money. And another good thing about these trades is they are high probability trades. So the trade I'll show you in a moment, the chances of this trade becoming successful is like more than 80%. So you can expect that 8 out of 10 trades will be winners. Of course, the way probabilities work is if you do a high probability trade, the money that it will make you will be less than the losses you can incur. Also, with high probability trades, if you have 8 out of 10 winners, the 2 losers that you will have, they will be very huge because the losses are bigger than the profits. So you need a proper trade management plan in place before you try to, or before you decide to indulge in these kind of trades. Now to set up this trade, I'm showing you this chart of Netflix that I've pulled up. It's a 1 year daily chart, and this is a screenshot from Think or Swim. At the bottom you will see these icons, the red and blue icons. These are all earning events, and what I've shown you is typically how much does Netflix move after they report earnings. Now what you will usually see is that the moves are less than 10%. So this is January 20th, 2023, 8.5%, April 19, 23, minus 3%, July 23, minus 8%. Now you do see some outliers. So for example, on 10/19/23, it moved 16%, and on 10/19/22, it moved 13%. Now, Netflix is a very volatile stock, so any kind of earnings surprises, like if they beat on subscriber numbers, earnings growth, forward guidance, anything will cause this stock to spike massively. Now, usually the options market is very efficient. So even if you're dealing with a highly volatile stock, the option market will usually predict how much the stock is going to move after the earnings event is done. So if you had gone back to this event, the one day before the earnings on 10/19/23, and you had pulled up the option chain, it would have already shown you that the market is expecting approximately a move between 15 to 18%. Now the market is not always right, but it's not for, especially when you're dealing with highly liquid stocks, you will never find that there is a huge discrepancy between what the market is expecting and what actually happened. So if you went back to 4/19/23, the market would have actually shown you that it's only expecting a 5% move or something like that. The actual move was 3%. On 10/19, the market would have shown you that it's expecting a move between 15 to 18%, and you got a 16% move. So just keep that in mind, that when you pull up options probabilities, they are pretty close to accurate. There are always outliers, and that's why there is no guaranteed trade that you can put, because it can always go against you. Now, having shown you that, let me show you the option chain that I was talking about. So if you pull up Netflix on any trading platform, any option trading platform, I'm showing you Think or Swim. Let me walk you through what we are seeing here. So first of all, when you're putting on an earnings Iron Condor, find the expiration that is closest to the earnings date. In this case, 26 January is closest to the earnings date. Today is 23rd January, so Netflix reports earnings after market close of 23rd. So I picked 26 January, which has 3 days left to expiration. That's number one. Now, this is the typical options chain. You can see the left side is call options. You can say calls here, and the right side is put options. And then in the middle, you have all these strikes. Okay, so there's nothing new there. Now, one interesting thing that you will notice here is on this side. So the platform I'm using is Think or Swim. And on many other platforms, you will find this too, that the platform is able to calculate how much the options market is expecting this stock to move by that expiration date. So in this case, the options market is showing you a $38.5 move to either side. It could be upside or downside. We don't know which way Netflix will go, but the options premiums are reflecting that is the expected move. Now that is a key piece of information that we already know. We don't know the direction of the move, but we know how much the move is. And that is what I'll use to construct this Iron Condor. Again, going back to the option chain, at the time of writing this, Netflix is trading at 490. That's the current stock price. The low end of the expected move, 490 minus 38 is approximately 445. That's the closest strike to the lower end of the expected move. And the higher end of the move is 525. So that gives us the wings of the Iron Condor. So you could sell a call option here and you could sell a put option here and construct your trade. But what we'll do is we'll add some buffer to add some safety to our trade. So instead of selling the 525 call option, I will add some buffer and sell the 535 call option. That's $10 above what the market is expecting Netflix to move. Now the 535 call option has 80% probability of expiring OTM. And you want that because you're selling the 535 option, call option, it'll bring you some premium. And the only way you will make money on this trade is that Netflix never goes above 535 by expiration date, which is on 26 January. So similarly on the put side, I have chosen a 435 put option. The market is expecting Netflix to stay below 445. I went $10 below that, and I'm showing you a 435 put option which has an 88% probability of expiring out of the money. So that provides us a decent margin of safety. Now since it's an Iron Condor, we are not selling a naked 435 put and selling a 535 call, because that is a strangle. We don't want to sell strangle because strangles are very capital intensive and mostly suitable for really large accounts. So instead of selling a strangle, so if I sell 435 put, what I'll do is I'll go ahead and buy the 430 put at the same time. Sell 435, buy 430. Similarly on the call side, I'll sell 535 call and buy 540 call as my protection. That constructs the Iron Condor. Now, this is how the structure of the Iron Condor will look like. We are selling this Iron Condor, so it says sell -1, Netflix 535, 540 call. That constructs your call credit spread. And then you're selling a 435, 430 put. That constructs your put side of the spread. And that's your Iron Condor. Now you will typically, if you read about Iron Condors, the most common way of selling Iron Condors is you should aim for making or bringing in a credit that is 1/3 of the width of your strikes. What that means is, in this case, the width of my strikes on any side, you just pick put side or call side, doesn't matter, right? So width of my strikes is $5. So 435 minus 430 is $5. That, if you divide that by 3, 1/3, that will come out to 133. So that is usually the best risk and reward setup for an Iron Condor. And that is what I have done. Instead of 133, in this case, my trading platform was showing that I'm able to get $140 instead of $133. So if I make 140, my maximum loss is 360. So first thing you'll notice is the profit on this trade is less than the maximum loss you can incur. And that is, there's nothing wrong with that. That is the nature of high probability trading. So when you're putting a high probability trade, in this case, this trade has a higher than 80% chance of success. So when you have a higher chance of success, the money that you can make is less and the losses you can incur will be higher. And so what you need to do is, in these kind of trades, is since it has more than 80% chance of success, that would mean that out of every 10 trades you place, you will most likely win 8 out of 10. So you'll have 2 losers and 8 winners. That is that probability of 80%. So the only problem is that when those two losers come in, they will have a really large loss. As you can see, it's like almost three times the loss of the profit that you're making. So with these trades, any kind of high probability trades, just not this trade, you will need to have a solid money management and risk management plan to be in place. So what I recommend for an iron condor like this is, if tomorrow morning, actually you will see the results tonight after Netflix reports earnings where the stock is trading. If Netflix is trading between your strikes, comfortably between your strikes, let me go back to this image. So Netflix is at 490. Let's say they miss earnings or subscriber growth is bad, right? And it drops to 470. You're way above the put that you sold. The put that you sold is 435. So you have a massive margin here. So if that is the case, this trade is going to be a full winner. You don't have to worry about too much. What you do is you place a closing order and buy the spread, buy the iron condor back for 10 cents. That is my recommendation. On many platforms, when you place a closing order for less than or 10 cents or less, they will not charge you any commission. So you sold it for 140, you're buying for 10 cents, and that's how you make a profit. So that is the scenario where you can win on this trade. Now let's say Netflix has comes with really bad, like disappointing earnings, bad guidance, subscriber numbers actually went down, and the stock plummets like crazy. So from 490 after market hours, it plummets to 435 or 430, which is now it's now testing the strikes that you have sold. So in this case, what will happen is you are most likely looking for a loss scenario. So how you would handle this scenario is, if you're looking at a possible loss scenario, what my recommendation is, when a stock spikes or drops that much after hours, in the morning when the market opens, it will make a brief attempt to come back. So let's say the stock is at 435 after hours and markets open in the morning, the stock will make an attempt to come back. So from, let's say, it goes from 435, starts going up, goes to 470 or 480 before it starts dropping again. Now when you see that move happen, that it's dropping again, that is when you would close your trade immediately. Do not wait for the trade to play out. Just get out of the trade, because your goal is not to turn a loser into a winner. Your goal is just to cap your losses, because you don't want to lose 360 on that trade. Now this is a really interesting trade setup, and I only do this in my larger accounts. And my recommendation is, if you want to play around with these trades, right? And in my book, you must have noticed that I've mentioned I do not trade earnings. So if I'm looking for a trade setup and it coincides, the expiration coincides with the earnings date, I will not take the trade. But that is what I do for the method that I've explained in my book, mean reversion trading, for my bread and butter trades. Now, as I mentioned earlier, this kind of trade is suitable for a larger account, or if you want to stay engaged in the market. Let's say you have like a $50,000 account, and if you're strictly following my trading method, then you'll find times when you can't find any trades, because every stock that you look at, there is an earnings event coming up. So this is a way for you to stay excited and be engaged during the earnings season, instead of just sitting on the sidelines. So you could, if you have a $50,000 account, let's say you keep maybe $1,000 aside for each earnings season. So you could, since each trade risks $360, you could do the math and then put those many trades during earnings season on stocks like Netflix, Apple, highly liquid stocks. So that keeps you engaged, it keeps things fun, and if the probabilities work out, then you actually make money too. So that's a nice way of staying engaged in the markets during earning season, while keeping your risk low, because these are high probability trades, but they do risk more money than they can make. So if you just have a simple trade management plan in place, these work out pretty good.